What's going on, everybody? It is Kevin coming to you with Weeds Weekly, and where we discuss what happened last week, right? The jobs report last week smashed forecast, smashed it. So what did that do for the market? Coming up on this week, we got inflation's turn. We're going to discuss that. We're also going to discuss where I expect rates to kind of settle here now as we're coming into July after this week. We're going to discuss, is now a great time to buy? We get the question all the time, right? Last week I discussed, is it a buyer or seller's market? This week we're going to discuss, is it a good time to buy? And lastly, I want to touch on proper expectations. As we continue our quest to move inventory out there, we want to talk about proper expectations. So let's just dive right into last week. And as we discussed moving into last week, we talked about there being a lot of mixed data. I expected it to be extremely volatile, which it was, but there was a lot of things that were mixed. We had some numbers come in higher than forecast, some come in lower. We had ISM numbers, we had PMI numbers. We saw that prices went down a little bit. We saw that expectations for purchase managers went up a little bit, what they anticipated. But the overall, as we wrapped up Thursday, was the feeling that the economy was slowing down. That we were moving into a phase where, okay, inflation has remained persistent. We have a consumer that seems to be pulling back. And now at this point, we were going to start seeing the labor market start to slow down. And weren't we surprised? Because on Friday, the non-farm payroll number smashed forecast. It came in 92,000 higher than anticipated, which sent the markets absolutely reeling. It took what we had at below 4.3% on the 10-year Treasury, which was at its lowest point since late March. I want to say March 29th off the top of my head, and moved it all the way back up to 4.5%, if not higher. And I think we still have an opportunity to move higher than that. So that was the big thing. But we are starting to get some mixed signals, which is a good sign that potentially, now we're talking maybe 6 months down the road, that what the Fed is trying to achieve, we might start seeing a slowing economy, right? We're already starting to see GDP come back a little bit, but these businesses just are flush with cash. There's nowhere really, right? Most recently, over the course of what's it now been, probably 12 months, if you're flush with cash as a business and you can put it to where it's easily accessible and you're earning over 5% interest on that money, you got a lot of excess capital. So that is continuously, in my opinion, to be one of the biggest hurdles that we're starting to see that's continuously hurting what the Fed is trying to achieve. And again, what does that mean, right? It means that if there's more jobs, we're also seeing wages increase slightly a little bit. There's more dollars chasing fewer goods. That's inflationary. And we can only anticipate that inflation is going to remain persistent. So that moves us into this week. And all we have is inflation's turn, right? We get the first week of the month, we get jobs. The second week of the month, we always get inflation. And that's exactly what we're going to have, but we have that coupled with a Fed policy meeting as well. But the big thing that we want to touch on is CPI. And my expectation for that, core CPI and CPI itself, I think it's going to come in right at forecast. And again, forecast is right around 3.5%. So if the Fed is trying to achieve 2%, we're still a far cry off. I think the markets would react pleasantly to a forecast that shows possibly that inflation is starting to get tamed just a little bit. That could equate to the potential for, remember, markets are always forward thinking, that they could be looking at a soft landing down the road, that they could anticipate that that is a possibility, that the Fed is on track, although it's going to be a long process, much longer than anyone anticipated. However, that might be on the radar. I think it's going to come in right around forecast, maybe slightly below. I think the market will have a slightly positive reaction to it, but I really think that jobs number last week is something that's weighing on investors' heads. And my expectation for the start of this week is they're going to do exactly that. They're going to hedge. You got to understand, a lot of traders got burned on Friday. All week we had these mixed signals. We had ADP numbers were down. We had the JOLT report for jobs was down, only to be absolutely blindsided by non-farm payrolls. So a lot of traders were not in a good position when that jobs report number came out. So you got to remember that. They're going to remember that, hopefully. And they're probably going to hedge, which is going to push interest rates slightly higher as we head into this week until we get to Wednesday. And we got the double whammy on Wednesday. We already talked about the inflation CPI number. We also have a Fed policy meeting. And let's be honest, there is a 0% chance that they're going to do a damn thing to the Fed funds rate. They're not going to do anything. I think they're going to change their rhetoric a little bit. They're going to indicate that the economy still remains healthy. I think they're going to say that it's healthier beyond what they thought. With this past week's jobs report, I think it kind of blew away what they'd anticipated, right? Because what the Fed is trying to achieve, they're trying to slow the economy down. Make no mistake about it. They need to bring inflation back into line. So that is something that they need to achieve. So that jobs number was not a great one from what the Fed was trying to accomplish. So let's remember that. But what I think is going to happen is I think the Fed is going to change that. They're going to remain that interest rates need to remain high. I think also, based on their comments, we're going to see a reaction that a potential for a September rate cut. I think you're going to be hovering down below or right around 40%. We were at a flip of a coin, I think, at the beginning of this week. But I think as we get that number and based on what they see, as much as I've said before that I think every aspect of government is political, I also think that they're just not going to be in a position to do it. As much as they want to be influential, they need to remain constant in keeping interest rates higher. The economy seems to be booming a little bit. I think it's running a little bit hot for what they're trying to achieve with inflation. And anything over 3%, I think, is a bad read at this point. They need to get inflation at least below 3% to even start changing their rhetoric that, well, maybe 2% was a little lofty goal and we need to bring that down a little bit. So, bringing me to where do I think rates are going to remain? I think rates are going to remain for the rest of this month right now and probably much into December between 6.75 and 7.5%. They're going to remain steady. I don't think that changes. I think that we're just stuck in this holding power pattern. We get a little bit of good data. We get a little bit of bad data as far as interest rates are concerned. And I just don't think that we're going anywhere, right? I think that this is what's going to remain. And I think what's going to happen also is we're going to see the market get a little bit tighter as we head into this election season, which is right around the corner. So that brings me into, is now the right time to buy? I get this question all the time. And the main point I want to think about is, there was a study, and let me find it right here. It wasn't a study, actually. There was some data that came out because I read it over the weekend, and it's the Home Purchase Sentiment Index. And that's basically the home buying index for the consumer, and it went all the way down to 14%. Its inception was in 2010, and this recently was its lowest reading that it ever had. So make no mistake about it, that these higher interest rates, the affordability of housing is the main concern, is putting pressure on home buyers. But the big point that I always like to say is, is it a good time to buy? And I think right now it always is a good time to buy. I think if you're ready, I think that the market is kind of bottomed out. I don't think you're going to see much of a price correction. It's due to lack of inventory. It's due to everyone swallowed up those really low interest rates. So I really don't think that even if interest rates come down a little bit, that's going to be due to a sluggish economy, which is kind of a double-edged sword. So I don't think if you wait or you buy now, I don't think you're going to see a major price correction. I think you should be out there looking. If now's the right time, there's opportunity, there's deals to be had. And as I always say, make an offer, make an offer, make an offer. That's how the process works. All someone can do is say no or not reply, and you move on and go on to the next house. So I think the lack of inventory is going to keep us up there. And I also think that the election, right? I think the election is going to be something that slows us down a little bit. But I think from a buy side, that if you're ready once again, I think there's going to be tremendous opportunities, especially in some of these warmer states where you have inventory that's been sitting and now you're coming into these summer months. I think it's going to create great buying opportunities for the right candidates. And I don't just mean investors. I mean first-time home buyers. I mean somebody that needs to move now because of a job change, or somebody that possibly is willing to move up or needs to move up because of a growing family, yeah, they have to sell. And yes, there's a little bit lack of maybe inventory out there, but I just think from a standpoint of, I don't think that housing values are going to decrease. And I think there's only upside opportunity if it's something that's a little bit more of a longer term hold for anywhere from about 4 to 6 years. I think you're going to do great. You're going to see appreciation and you're going to make money. So the last thing is just proper expectations. So often I'm now doing a weekly Instagram show called What's Brewing. And a topic that came up was, how to best prepare yourself as you head out into the market for a buyer. And the biggest thing I stressed was, look, if you're a real estate agent, it's sexy going out and showing houses, right? You get to see the nice new shiny house, or somebody's super excited because they're moving out of their condo. Or overall, the feeling is just great. It's a great feeling. You feel good. They feel good. It's fun. It's energy. On the flip side of that, you're the mortgage side. The mortgage side is where the rubber meets the road. And I think that's where I think a lot of real estate professionals need to get better into the habit of engaging their client with their mortgage professionals sooner. I think the time is now, given how affordability is such a growing concern with appreciation and where interest rates are today, that we as real estate professionals, you as a real estate professional, need to be talking to your client a little bit more like, okay, who have you talked to on the mortgage side? Who have you engaged? Do you need help? I'm happy to jump on a call. I'm happy to get engaged with you sooner in the process. I think by setting those proper expectations with regards to what they can afford, how taxes and insurance play into it, what is their payment going to be, and then working that backwards to what they could purchase, what is the home value they should be looking for, because then you as a real estate professional can get a little bit more prepared with what exactly is their budget, making sure you're not showing them houses outside their budget to get them super excited about something they can't afford. Because when they then go look at something they can afford, they're not so excited anymore. It's not as sexy. And it can blow an entire client that is ready now to buy from actually purchasing a home. In an end, it could be the perfect home for them. They just don't know it. And in 3 to 5 years down the road, that house could actually appreciate the most, creating the most wealth for your client, and you're going to be the hero. So I think setting those proper expectations by engaging your mortgage professional sooner is going to assist you in moving more products. So I wouldn't hesitate. And if you don't have a good one, then I strongly would advocate that we sit down again so we can discuss my approach to make sure it jives with what you're trying to achieve, so that together we can put your client in the best position possible to buy that house. Right? To get them off the fence, to get them believing that now is a great time to buy, because in my opinion, I think we're getting really close to a fantastic time to buy. So, all right, everybody, I hope you have a great week, right? We are in an inflation week, so expect a lot of volatility for interest rates. Even better yet, anyone that's currently in the market, make sure that they have their mortgage professional on speed dial, because like last week, everyone should have locked in earlier in the week, because Friday, things got a little bit ugly with interest rates. People could have been 1/4 to 3/8 lower once again. And we can see week after week after week, it's kind of the same message of how volatile interest rates are. So it's extremely critical for your clients to lock in those lows so that they're not subjected to the highs. All right, you need any help? I'm a phone call, text, email away. You want to grab a coffee, now's a great time, right? We want to be inside, but it is going to be inside because it's so hot outside. But love to sit down, talk shop with you anytime soon, and love to be a person that sets those proper expectations for your clients. Have a great week. Happy selling out there. You need anything, you give me a buzz.